Good afternoon and welcome to today's call, Second Quarter Market Update. This is Catherine Barr, New Capital's Director of Communication and Client Services. Before we get started with the webinar, I have to offer the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you, and with that, I'm going to turn it over to Leonard.
Thank you, Catherine. It's great to be with everybody today. And I can't see your smiling faces, but you can see mine. Let's see, I'm unmuted here. I've got to do a few things. So I'm going to make two presentations today. The first is going to be the usual review and market update of how things did during the second quarter. And then I'm going to do a kind of a second little presentation that I'm calling Presidential Chaos. And that's certainly been the case over the last few days. And I'm going to try to put that into a kind of current and historical context, and also talk about some demographics and some country-specific statistics that I think will be helpful in putting the current geopolitical issues into a little bit of perspective from a numbers standpoint. So with that, I'm gonna share my screen, and as Catherine said, we're using this new technology today. We threw out the old one. We didn't get a very good review for it, and so we got rid of it. We wanted to make sure we listened to our clients, and hopefully this new software will be good. But please let us know at the end of it. If it's not good, we'll throw it out too until we find something that works to your liking. We want to make sure that you like it. All right, so I'm going to share my screen. So this is, again, we're reviewing the second quarter, which ended just a couple of weeks ago. And here are the major categories. We can see that the US stock market did almost 4% in the quarter. So pretty strong performance by US stock market. International developed stocks were down 0.75%. However, a lot of that lack of or failure to keep pace with US stocks was the result of the depreciation of the dollar versus, I think, every single foreign currency. I don't know that there was a single foreign currency in the entire world, we're going to look at that slide in a little bit, that was positive versus the US dollar. It was that strong of a quarter for the dollar, and that's the result of all the tariff and trade actions that are going on. Todd says no, but we'll see what his opinion is. Emerging markets had a very tough quarter, which was the result of the tariff actions, down almost 8%. And in Todd's presentation, he's going to talk about our thoughts on emerging markets and where that's at in more detail. Global real estate was up 6%, and that was on the back of very strong performance by the US real estate sector, not so much the international real estate sector, which was flat. So the US real estate sector had a very strong quarter. We tried to find out why, and we couldn't really, Todd will talk about it. Last time we talked about it, we couldn't figure out why that was, or didn't see any information on it. But so very, very strong. And that's a reversal from more recent quarters where international real estate has been much stronger than US real estate, especially the first quarter. That was the case. US bond market was pretty flat, down 16 basis points. And the global bond market was actually up 48 basis points. So those are that's the performance of our major classes of assets for the period. And here is the second quarter, some headlines that went on. Let me see if I can activate this. Let me see if I can activate the annotation thingamajig here. Draw. All right. Over the quarter, U.S. factories report strong demand as tariffs and prices threaten expansion. That was here. China's trade surplus with the U.S. soars toward the beginning of the quarter. Consumers shy away from spending despite tax cuts. International Monetary Fund forecasts global growth of 3.9% this year. To put that in perspective, that's pretty strong. Pretty strong growth that the International Monetary Fund is predicting. The yield on the 10-year U.S. government bond hits 3% for the first time in years. So everyone was waiting for that to happen, and that happened in the early part of the quarter. Growth cooled in the first quarter as consumers reined in spending. So kind of same as that. Oil prices reached the highest level since 2014. We saw a very strong rebound in oil prices over the quarter, and that led to strong performance of energy stocks. Trump pulls out of the Iran deal back in late April. Who can even remember that, right? I mean, that seems like that was 10 years ago that Trump pulled the U.S. out of the Iran deal, but it was only a couple months ago. Small caps set new highs, outpacing their multinational peers. We've seen a distinct outperformance this year of small cap stocks, which has been very good for new capital portfolios because our portfolios tilt toward small caps. However, we also tilt toward value stocks, and those have not outperformed, actually have underperformed. So it's kind of an ambiguous result. Eurozone business activity continues to slow for the fourth straight month. Private sector adds fewer jobs in May as businesses struggle to fill openings. And we are operating at really close to what is considered to be full employment. That doesn't mean everybody's working. That's not the technical economic definition of full employment. But we have people pretty much employed who want to be employed. And so we're running at very, very low unemployment right now. And as I think most everybody knows, we're in the midst of an anti-immigration government policy right now, and that's making it even harder to fill jobs. NASDAQ climbs to a record in late May, and I think NASDAQ actually hit another record yesterday even. So we've seen very strong performance from the technology sector. Unemployment rate falls to an 18-year low. Trump and Kim embark on a new path. That was that seems like 10 years ago, even though it was just a couple weeks ago. U.S. and China tariffs hit American-made products from chips to cars. Economic growth in the U.S. leaves the world behind, so U.S. experiencing stronger growth than the rest of the world. Inflation rate hits 6-year high in May, and China sends the yuan to fresh 6-month lows. So a very, very action-packed period over the last quarter. But let me get rid of all that. How do I get rid of that writing? Clear all drawing. All right, there it is. Okay, world assets, and again, we can see that U.S. stocks in general were mostly positive, and international stocks mostly negative during this period for world assets. Clear all drawing. Okay. U.S. market accounts for 53% of the global market cap, showing about $28 trillion. And as I was saying before, we've had very strong performance from small companies this year. And you can see that all of the top performers of these three categories are small. So small cap valued at 8.3%. Small cap blends did 7.75% and 7.23% for small cap growth. large growth also did well, 5.76%. And here you can see large cap value stocks, things like financials or basic materials, industrials, did not nearly keep up with the other categories. As you know, we run diversified portfolios here, and so your portfolio would have participated in all of these categories, and we do lean towards small company stocks. So it was a good result for New Capital portfolios from that perspective. International stocks, 35% of stock market capitalization. Growth stocks, 5% performance for growth stocks internationally. You can see that we have a divergence in performance. This is local currency right here on this side. I'm sorry. This is local currency on this side, and this is in U.S. terms. And so these international stocks did well in a local currency, on a local currency basis, but when it was translated to U.S. investors, we had negative results. And you might say, well, why don't you hedge the currencies? Why don't the fund managers that we own hedge the currencies? And the reason that we don't is that you just never know from one quarter to the next what currencies are going to do. They're notoriously fickle. I remember in business school, one of the first exercises that we were ever given was a currency trading game. And everybody was given $1,000 or something like that to trade currencies. And everybody went out and said, oh, I'm going to be able to nail this. And you know, 90% of the class was deep in the hole on their currency trading activities. And some very, very quickly. Currencies can turn against you very quickly. And so in a world where currencies are, for the most part, floating, we prefer to get currency diversification. So there are going to be some quarters. And so, for example, last year, we had a huge boost from the depreciation of the dollar versus foreign currencies. And I think we got 10% extra performance in the portfolios last year as a result. And this year we're getting a different result. So that's the way it goes. All right. Next is emerging markets, and it was just a very difficult quarter for emerging markets all the way around. We saw losses that were around 8% plus or so. However, emerging markets constitute a small percentage, maybe 10% of our equity portfolios. And so we don't feel that pain nearly as much as if we held 100% of stocks in emerging markets. Clear my formatting again. These are best performing countries. Best performing developed market country was Israel. Look at that. Country of Israel, 6%. Led all developed nations, and the worst performing was Austria, minus 8.79. And so, you know, that was the range of performance across all of these. And here was the United States. After Israel was Norway, Canada, Australia, US, UK. And here in emerging markets, you see just about everybody was negative, some very negative. Turkey with its political problems, minus 25%, in Brazil, which had been performing, you know, very well over the past really couple years, minus 26% in Brazil. The only countries here that were positive were Colombia and Qatar. So who knew? All right, next, currencies. Let me clear my drawings. And you can see that it's red all over the page. So these are how did foreign currencies do versus the dollar. And the only one that had any bit of appreciation versus the dollar was the Hong Kong dollar. That's it. And a very, very modest, almost negligible, imperceptible gain versus the US dollar. Otherwise, everything very, very negative versus the US dollar, including the Turkish lira and the Brazilian real. And so you can see that the reason that emerging market equities did very poorly is look at the depreciation of the currencies. Okay, we talked about real estate a little bit earlier, but here you can see that US Real estate trusts did almost 10%, and global REITs were roughly flat. But again, remember the currency effect had an impact there. Commodities. Interesting time to be watching commodities now that we see some inflation ticking up. Here is the strong performance of oil, 16%. For Brent crude, WTI West Texas Intermediate, 12.7. So a strong return to form by oil over this quarter. But it wasn't that all commodities did well. About half of them in this list did, but we had a lot of negative too. Look at corn. Look at soybean oil. Look at soybean meal, and look at soybeans. There's a theme going on here, everybody. What is it? Well, look at the effect that tariffs are having on the U.S. agricultural sector here in soybeans. Soybeans are a major export from the United States to China. And now that the Chinese government is putting tariffs on things like soybean and corn, there is a reduction in the amount of soybeans being purchased. Excuse me. I found out that soybeans are actually used and purchased by the Chinese primarily. I should have put this as a survey question, Catherine. I should have put it as a survey question, but I didn't. You know what it's used for? It's used to feed to their pigs, to their hogs. That's what they use it for. So they're taking American soybeans and turning it into Chinese pork. And so look at the drop in soybean prices, almost 20% drop, and that is, of course, having, I'm sure most of you have heard, that's having an effect on farm country in the United States. Here is the fixed income picture and the interest rate picture. I'm not going to spend a lot of time on this because Todd is going to talk about it, but really we can't show this to you too much. This is the yield curve. And you've probably been reading stories about the yield curve and the flattening of the yield curve. And does a flat yield curve mean that there's a recession up ahead? And the answer is we don't know, but it has often been an indicator of a recession. And so an inverted yield curve. An inverted yield curve would look like this, right? Which means that you're receiving a higher interest rate for a shorter term bond than you're getting for a longer term bond. And generally, you would only want to have that situation if you thought that interest rates were going to continue to fall and that you wanted to lock in the current 30-year interest rate. Well, here is where this line right here that I'm drawing on is a year ago, where the curve was, and you can see that shorter term interest rates were much lower than they are right now, which is right about here. And that's because the Federal Reserve has raised interest rates over the last year. But look, the long-term interest rates have basically remained the same over the last year, right? They're all bunched up together. And so because the short end has moved up and the long end has remained stationary, the curve, which was this, is now flattish. Everybody can see that there. And so the concern is if it went negative like that. Okay, Catherine, okay, here we go. And now I'm going to go to my other presentation. We've got presidential chaos and webinar chaos. Obviously, everybody is aware that the US presidency has gotten increasingly chaotic. And especially over the last couple of days since the meeting, the secret meeting that was held in Helsinki between President Trump and President Putin. And really that chaos continues today as the President of the United States continues to literally ping pong back and forth between a position as to whether our electoral systems are under threat. And I think everybody should pause and think about the implications of that. We have an election that is coming up in November, and we know from the intelligence agencies, it is unanimous among the intelligence agencies that the 2016 election was attacked, and it was attacked by Russia. And the general belief among the intelligence agencies is that it was attacked on the orders of Putin himself. And so over the last couple of days, it's been startling for everyone to reflect on basically the side that was taken by President Trump, he taking the side of President Putin over the side of American intelligence agencies. And there are some Americans who are calling that treasonous. I'm your financial advisor, so I'm not going to tell you what I'm thinking about it, but I think most people think it's a questionable thing. So I thought it would be good to do a sort of survey of my own thinking about what damage looks like. And what does a damage report look like? And if there are any Trump supporters listening out there today, it may be damage that you like. You know, whenever you're in a war, you can give a damage report on the enemy, and so you want to see damage there. On the other hand, if you're not a Trump supporter, you probably don't want to see this kind of damage. And there's nothing scientific about that. I'm just trying to give everybody some categories in terms of how to think about how the presidential chaos has been developing. Regulatory infrastructure is the first category. I think everybody knows that the executive branch under the Trump administration has really taken a sledgehammer to regulations in so many different areas. And so I've given that a severity level of 3 for regulatory infrastructure. Domestic politics, I think severity level is 3. We have an incredible amount of domestic strife. And it has only gotten worse as the president has taken an approach that is divisive. He said the night that he was elected that he wanted to govern for everybody, but it became pretty apparent during the transition in late 2016 that that was not going to be the case. I'm not a supporter of the president. I wasn't a supporter of the president, and I paid attention very, very carefully during the transition period, last 3 months or last 2 months of 2016, and into January as to whether we were going to see some conciliatory presidential term. But it became apparent very early on in the transition that that is not the case. And so what that has resulted in is increasingly difficult, conflictual domestic politics, and it doesn't look like there's going to be any end to that. I expect that to continue to accelerate as we come closer to the elections. The rhetoric is going to be coming. We haven't seen anything yet of what we are going to see, and so I mean that could go to 11 as Spinal Tap said. Global diplomacy and trade is a 3. Healthcare is a 2. The Affordable Care Act remains in operation, but it has taken lots and lots of blows. And so the healthcare insurance of people in the country that they're facing large premium increases. The federal deficit, there were the tax cuts, seems to have had a beneficial effect for some businesses. However, it has also increased the deficit. Sorry, I don't know. Scale. Oh, everyone's asking about the scale. Scale is 1, 2, 3. 1, 2, and 3. Okay, everybody, thank you for the question. The scale is 1 to 3 being most severe. I didn't want to go with a 10-point scale. Great question. 2 is medium severity, and 1 is lower severity. Federal deficit, we're now seeing, I think it's estimated to be increased about $1 trillion. Todd, is that right? About $1 trillion increase in our federal deficit. And in our debt level. So it's a $1 trillion increase in our debt, right? Resulting from the $1 trillion on the deficit. Lost revenues from taxes. So, we're all going to find out how that tax cut plays out over the long term, but in the immediate term, we're exploding the deficit more. Our legal and constitutional systems, I put those at a severity level of 2. It appears that these are holding and the system is working, and yet they are taking some really, really severe blows and challenges. The court system and the legal systems are really having to work overtime in many different areas, whether that's the immigration system that is facing such overwhelming numbers of people that they suddenly have to process because of changes in policy that the Trump administration has pushed through, to regulatory. The courts are working absolutely on overtime and being pushed to the brink. Corporate and business health, I think most people would agree, is doing pretty well. And I put that at a severity level of 1. I would say that there is some severity there because of the trade picture and the tariff picture. That's having an impact on certain industries. So for example, I'm looking for a new cast iron wood burning stove for my ranch, And a few months ago, I went and looked, and I should have bought it then because it was about $699. And now it's about $1,099. That's about a $400 increase. That's a heavy thing. That's a lot of metal going into that. And so, I may or may not get it. I'm probably going to end up getting it because I don't want to be cold in the winter and in this new barn I've got. But there are going to be a lot of people who say, I'm just going to lay off and not buy that particular product. There's word that a big company that makes nails here in the United States is really having some difficulty. And so I don't think we can conclude that just because in general businesses and corporations are doing well, that we're not seeing dislocations from the result of tariffs. Stock and bond markets are, as I think everybody on the call knows, have been holding their own. And I've been surprised that none of this presidential chaos, really none of it, has translated into negative impacts on stock and bond markets. I've been very, very surprised, but I think that the conclusion we can draw is that, as H.L. Mencken, the American writer, said, the business of America is business, and the business of America continues to go on. People continue to get up and go to their jobs and make products and provide services, despite what is going on in the government. And so stock and bond markets have held steady, and it just goes to show that we can't always equate political risk, even political risk that materializes, as transmitting directly into stock and bond prices. I've put a question mark on our electoral systems. We don't know. And of course, this continues to be the news over the last 2-3 days as to what is the state of the American electoral system and what is the President of the United States prepared to do, if anything, to speak up in order to strengthen our electoral systems moving into the November elections, especially in the wake of an election in 2016, when the indications are, admittedly now by President Putin the other day, admittedly were geared to, the systems were hacked in order to try to throw the election to Donald Trump. When I say the systems, I mean the mass communication, mass media systems, Facebook, and so on. There's no indication that the electoral booths were, voting booths were actually hacked themselves. But they were attempted to be hacked. The Russians attempted to hack the actual voting booths. And so we don't know. And there is a lot of focus now, with a few months left, as to whether those systems are going to be okay. How's my time, Catherine? Okay, just real quick, I'm going to talk about Russia. I was a Russian history major in college, and so I just wanted to make some comments about Russia. Russia, of course, has a limited history with democracy. Only a few periods, and generally after revolutions, has Russia had anything that even resembled a democracy, and it didn't go that well. Russia has in general been an authoritarian government under Tsars for many centuries, the Soviet Politburo, and now we have an oligarchy at the head of it is Vladimir Putin. Russia uniquely is centered in Moscow. I mean, Moscow is the center of the Russian universe, and nobody should ever underestimate how critical and vital the role of Moscow is. And so if you have control of Moscow, then you've got control of Russia. And that's been that way for the beginning of Russia, going way back into the mists of time. In World War II, I think most Americans do not appreciate Russian valor that occurred in World War II. In the Battle of Stalingrad, German armies were at the gates of 3 factories along the Volga River. And if the German army, 6th Army, had taken those 3 factories, the German army would have been in control of oil from the Middle East all the way into Europe, and Russia would have been pushed back beyond the Volga River. And so the valor and the fight in the army at Stalingrad literally turned the war. And I don't think enough Americans appreciate that fact. And if anybody, believes that Americans should have been more deferential to Russians over the last 20 years since their revolution, that's where the argument would be, that there needs to be more appreciation of the sacrifice of Russians. The tank battle at Kursk about a year later, biggest tank battle in history, again won by the Soviets, and the capture of Berlin was not accomplished by American armies. It was accomplished by Soviet armies at great cost to the Red Army, but they were determined to have their revenge, and they did in Berlin. The Cold War, of course, lasted from 1947 to 1991. I can remember, of course, Russia being this big, big enemy. And so the last 20 years have been sort of a breath of fresh. There was a revolution, and first constitution, the USSR fell apart. And from 1991 to 1993, you might remember Boris Yeltsin, who was president of Russia during this time. It was a chaotic period. Imagine the place just fell apart, and a new constitution was put into place in 1993 through the present, and that made a provision for a strong presidency. So we wound up with a strong presidency, now occupied by Vladimir Putin, in this 1993 constitution. And of course, the most recent, 2016, a cyber attack on the US presidential election. We know about the invasion of Crimea and the conflict in Syria. Real quick, some country comparisons. Just to put things in perspective, the United States has a population of 325 million. Our GDP is $19 trillion. We have a GDP per capita of $58,000 and a stock market value of $24 trillion. And I've sorted this by GDP per capita. Where is Russia? Here is Russia. 144 million people. GDP is $1 trillion versus the United States, $19 trillion. I mean, everybody, let that sink in. 1/19 of our GDP. GDP per capita, $7,000 per person in Russia versus our $58,000 per capita. And their stock market value, less than $1 trillion, $0.6 trillion, $600 billion. Look at Canada, 1.4 trillion in stock market value, GDP of 1.5 trillion. Japan, $5 trillion in GDP. The European Union, $16 trillion. China, $11 trillion. Stock market valuations of 3.4 trillion and 9 trillion. And it causes, so when you look at this chart, it causes the question, why is the president going to war against all these guys and pumping up these guys, right? This is what the numbers show. You know, why would we get into a trade war with these countries? Maybe he's got a strategy, but you know, I think everybody's waiting to know and see what that strategy is. Very interesting, and then I'm going to wrap it up here and hand it over to Todd. The USA accounts for 8% of the population of all these countries put together. It's not 8% of the world, just of this sample, okay? So don't misunderstand me here. Of this sample of countries, 34% the US represents of GDP. And we represent almost 60% of the stock market value of all of these countries. So that's why China might not want to get in a trade war with the United States, or other countries might not. Here's Russia. Just to reiterate the previous slide, 4% of the population of all of these countries put together, 2% of the GDP of all of these countries put together, and 1% of the stock market value. Versus the EU, 28% of the GDP, 22% of the stock market value. China, 19% of GDP, 4% of stock market value. Japan, 9% of GDP of this sampling of countries and 8% of stock market value. Even Canada, 3% of GDP, more than Russia, with 1/5 the number of people. And so this is the question that we should all be asking about Russia. To what extent is Russia a threat? How can it be this massive major threat when it constitutes such a small part of the world economy? And why would the President of the United States be inducing this chaos on behalf of a country that is as weak economically as Russia is? I don't have any answers, but maybe we can discuss that I don't have any answers. I would say there are a lot of answers, and maybe we can take some Q&A about that. So that ends my presentation for today. I hope that was helpful. I'm going to push all my buttons here. I'm going to pause my share, turn it back to Catherine to turn it over to Todd, and thanks for your time and attention today.
Okay, great. So it looks like we're up and running. So to kind of piggyback on what Leonard talked about from the second quarter performance, I'm going to talk a little bit about what we're looking at going forward. And as Leonard had alluded to, it was a very interesting quarter with lots of headlines and lots of geopolitical events that are very hard to discount, to be honest with you, and very hard to understand their impact, what their impact will be to asset markets going forward. But nonetheless, things we need to pay attention to that could have an impact on our portfolios. So I'm going to talk about four just kind of broad topics. We'll start with earnings and valuations, particularly in the United States. Talk about inflation and interest rates and kind of what we see there, and how all that feeds into the global growth story, where trade risks are a major impediment to that story. And then, as Leonard had alluded to in his earlier comments, we'll talk about emerging markets. And we're still constructive on emerging markets. I know I've written that in a couple of newsletters over the last couple of months. But as Leonard had shown, it was a very tough quarter. It could remain, it could be like that for some time. And I'll get into that in a little more detail as we go through the slides. So to start, this is a new slide just showing the S&P 500, really going back to 1997. And I think it's pretty interesting to see the path that we've gone, going back to the top of the market in 2000, the tech bubble. We topped out again, as we know, in 2007, and here's where we are today. And a couple things I want to point out here is, first of all, look at this expansion. It's been just a tremendous growth expansion we've seen since the bottom in March of 2009. And so we're up over 300% on the S&P 500 over that time frame, and amassed an enormous amount of wealth. But to put that in context from a valuation perspective, the market right now is trading about 16.1 times earnings. And you can see at previous tops, it was at 15.7 back here in 2007. And the tech crisis, we know, it was much higher, 27.2. So there are a lot of market pundits that would say that the market is somewhat fairly valued. And I would agree with them to a point. And the caveat to that whole thing is this number here, which is forward estimates. So what market pundits are referring to when they say 16.1 times forward earnings, the same times forward or projected earnings. If you actually look what the market is trading on trailing 12-month, the actual realized earnings, it's closer to 20 times, which is on the higher end of the historical average. So the reason I bring that up is, where will the market go? Will the market continue to go higher from here, or can we start to see it go down here? And a lot of that has to do with what we think will happen to earnings. And so here's a picture of the earnings, and I've shown this slide before on other calls. And you can see here that the first quarter earnings came in at $36.54. And we've just seen a massive increase in earnings, and there's an expectation that earnings are going to continue to increase. Right now, the market anticipates earning growth of about 21% for 2018. That's phenomenal. When you think about, on average, it's typically 9 to 10%. And so why are we at 21%? A lot of that is predominantly from the tax cut. And so we could characterize this phenomenon here as a sugar high, and a lot of people in the markets are. And so the question is, what will earnings look like in 2019 if the tax cuts that are largely front-loaded wear off? And the expectation is earnings may go back to 9%, which is a historical average. And so if that does happen, what does that mean for the stock market? What does that mean for valuations? So that's what we tend to watch. That's what we tend to watch over the coming months, is to see, what the earnings picture looks like. I will say this, that historically, analyst estimates, these are Wall Street estimates, are optimistic at the beginning of the year when they project earnings. And what we find is that during the year, as the earnings picture starts to come through, they revise their earnings downward. This year, in both quarters, first quarter and second quarter, they revised upward. So it seems that Wall Street estimates actually were on the lower end entering the year and underestimated the impact of the tax stimulus that was going through. And so that's why you see the markets actually continue to march higher. So, Leonard had said it doesn't seem that the markets are really factoring in the volatility created by President Trump. And actually, I challenge that a little bit and say I think they actually are. Because if you actually think about stock market earnings at 21%, and the stock market only up over about 3 or 4% for the year, something doesn't jive. And I think what's happening is that the earnings picture actually is allowing the U.S. market to continue to truck ahead despite of a lot of the headwinds that are being created by this administration. And so, so again, something that we continue to watch very closely. So the other thing we talk about, so we talk about earnings, and a big part of the earnings picture is going to be what's going to happen on the inflation front. And so I think the first thing to look at is this picture here. And a lot of people have questioned, are we actually seeing inflation? I think Leonard gave us a pretty good anecdote that he is seeing some extraordinary inflation on some industrial products. But more importantly, look here, right? 2015 numbers versus 2018 numbers. Average hourly earnings were at 2.4% year-over-year change. In 2018, we're 2.7. Employment cost index was at 2.7. Wages, 3.1, they're up 3.2. Core CPI, 2%, 2.2. Oil price was year-over-year change in 2015, they were down 30. 2018, they're up 63. And then headline CPI was only half a percent. In 2015, we're up almost close to 3%. So all trending in the upward direction. And so this is what the Fed is watching. And this is what could have a big impact on really the earnings picture, going back to the previous slide, and how corporations are going to be able to make profits. And so, you know, there's no question about it. We're showing the classic signs of the mid to late cycle dynamics. And that's really characterized by growth peaking, and we've seen strong growth. Margins are at their high point. We're starting to see inflation, and we'll see the Fed on a tightening path. And so those are all classic late cycle, mid to late cycle phenomena. And then not to mention the yield curve, which Leonard had alluded to, and I'll talk about that in a little bit. A flat yield curve is indicative of a late cycle as well. So everything points to the fact that, and I think I wrote this in the newsletter, you know, if you think about a game of baseball, you know, we're definitely not in the early inning. We're definitely in the late innings. The question is, where are we? If it's a 9-inning game, are we in the 7th inning? Are we in the 8th inning? Are we in the 6th inning? And I think we're closer probably to the 8th or 9th inning than we are to the 5th or 6th inning. But you know, we will continue to watch the numbers to get a better picture of that. So where do we think interest rate's going to go? And we'll start first with the Fed, right? And so this is just a picture of the Fed funds rate going back to 1999 to where we are today. And you can see what the Fed did, raise interest rates into the turn of the century, and then eventually got to a point where they paused, and then we went into a recession. And then at the bottom of the recession, the Fed, as we started growing again, the Fed raised interest rates, paused into the global financial crisis, and here we are on the path now. So a couple of things here is, first of all, they're showing a much more measured pace than they have previously. If you look at the slope of these lines versus this. So the Fed hopefully maybe learned their lesson. There's some argument there. Maybe they tightened too fast. The Fed tends to do that in previous cycles. And so they're definitely not tightening too fast, as you can see here. But if we look at what we think the Fed is going to do, this blue line here, this is their projections, and the red line, this is the market expectations. And so they're pretty close. They kind of separate here what will happen in 2019. And so there's some separation there, what the market thinks the Fed will do and what the Fed believes they will do. But ultimately, what they're trying to get to is a normalization rate of about 3%. So how long will it take to get there? Well, if you look up here in this box, you can see that these are the long-run Fed projections. So this is what the Fed is looking at, these three factors, when they decide if they're going to raise interest rates or not. And so if their forecast for GDP is 2.8% in 2018, and 2.4% in 2019, and 2% in 2020, but their long-run forecast is 1.8, that would tell me that the Fed has room to raise interest rates if they're comfortable with the 1.8% long-term GDP forecast. If they raise interest rates, that could actually slow growth and hinder growth. That would be the intention behind that. And so their long-run forecast is well below what their run rate looks like. Same thing with unemployment. Their long-run forecast for unemployment is 4.5%. We're running at 3.6, and we're anticipating to going below that, to the lowest we've seen in decades, to the low threes, 3.5, maybe I've even heard some estimates, maybe 3.2. So the Fed should be comfortable in raising interest rates if they think long-term unemployment should be at 4.5. And then inflation, their long-run inflation number is 2%. We're running at over that at 2.1. And so again, I think these three components give us the indication that the Fed is comfortable raising interest rates and will probably continue to do so in that regard. The other, I would say, gorilla in the room that we've talked about before is what's going on with the Fed balance sheet. And this is going to have massive implications to interest rates over the long term. So this slide here on the left shows the balance sheet of the US Federal Reserve, the Bank of Japan, the European Central Bank, and the Bank of England. And what you can see here is that prior to this point, all central banks across the world were really expanding. And then the Fed started to wind down the balance sheet, has started to taper off their balance sheet, as we've talked about before. But look at, not only did the Fed start to do that, but the global central banks are all doing it as well. And if you look at the orange line, we can see that projected past 2019 to 2020, that all central banks across the world will be in a tightening mode, not an easing mode. So all that money, all that liquidity that was used to source a lot of the growth that we've experienced and enjoyed, that 302% market increase I showed in the first slide, all that liquidity is going to be sucked out of the system. And that is going to be a hindrance on growth. And it's going to be pressure on rising interest rates. Additionally, if we look out here, this is the projected Fed rate cuts or increases by the top 10 developed market central banks. And, you know, in 2008, 2009, 2010, 11, you can see that there were more cuts than there were hikes for the most part. What's going on in the future? Almost nobody's going to be cutting. Everybody's going to be increasing interest rates. So a lot of upward pressure on interest rates. And so what does that mean for the yield curve? And so here, Leonard had shown a picture on the DFA slides of the yield curve. And this is just showing two different perspectives, one from 2013, the other from 2018, just at the end of the quarter. And you can see how flat the curve is versus what we saw 5 years ago. And what I did was I did a quick calculation here. And I'm calculating the spread or the slope of the yield curve, the degree of flatness or steepness that the market concentrates on. So when people say the curve is getting flat, what the market is looking at is they're looking at the 2-year rate predominantly versus the 10-year rate. And so if I take a 10-year rate of 2.9 minus a 2-year rate of 2.5, the curve is only 0.4% steep versus where it was 5 years ago, 0.4 versus 3%. It was 260 basis points wide. So this is very, very indicative of a growing economy, of an early stage cycle. You tend to see steep yield curves as an economy starts to come out of recession, as the economy starts to heal and profits start to increase. This is very indicative, as I said before, of a very late mature cycle economy. And so this is not atypical, and it is not a shock. What Leonard was referring to is we want to make sure it doesn't do that inversion where we see short-term rates are higher than long-term rates. And we're not there yet. We still have some room. We still have about 40 basis points before we're completely flat. And then if we go any further, we'd be inverted. I do want to say that inverted yield curve is indicative of a recession. And it has preceded almost every single recession going back to the 60s. But a flat yield curve is a little different. A flat yield curve actually, believe it or not, is actually helpful or positive for an economy, and really positive for an economy driven by consumers. So if you think about the U.S. economy, where 70% of the GDP is driven by consumption, consumers now are earning a lot on their cash, because look at short-term interest rates have raised quite a bit. So you're getting a lot of interest on your savings, and then housing, which we all know is a big driver of the U.S. economy, mortgage rates are staying low. And so the market can continue to go higher in a regime with a flat yield curve. If we look at the consumption model and how that plays out for the U.S. However, if it continues on that path where it does start to invert, that starts to signal something different and starts to signal that the market is anticipating that the Fed may have to cut rates in the future and interest rates may be low in the future, and therefore you'll see the curve invert. So right now, watching it very closely, but the flat yield curve still is supportive at this point of equity prices. Last few slides we'll talk about are the global economy and the health of the global economy. And here's where we're starting to see a few things that are a bit concerning, I'll be honest. And so you've seen this slide before. This is a slide that I like to show every quarter, showing the Global Purchasing Manager Index, which really is the overall health of the economy, and a good leading indicator of what the manufacturing sector is anticipating. And you can see here, in 2008, when everything was red, that meant that their numbers, anything less than 50 is an economy, or the anticipation the economy is going to contract. Anything greater than 50 is the expectation the economy is going to expand. You can see in 2008, everything was almost below 50. We saw again the European financial crisis here in 2012. The U.S. was okay, but we know in Europe they had a problem, and you can see this indicator was indicative of that. And what do we have now? Very green. And so this is what we've been talking about for several quarters now. This global growth expansion underway, and we saw that in asset prices last year. But this year, as we start to look at it, we're starting to see it's still green, but less so. And I think this slide here helps kind of put that into context. And so this slide here is kind of showing us what how many countries with manufacturing PMIs are over 50. And look what's happened here over the last quarter. We're starting to see that the growth that we saw in increasing PMIs is starting to roll over a bit. And actually the number of countries with improving PMIs is starting to drop. And so this is something we want to watch very closely. We don't know if we're going to see a period like this where the market just where it continues to go up, or we're going to see a period like this where it just continues to fall. But these are indicators that we're looking at when we look at your portfolios, when you see the risk in your portfolios that we want to be cognizant of and make sure that we're ahead of this. Because if this starts to slow down, that's going to be a negative for equity prices and the global economy in general. The other impediment to the global economy, global trade. And Leonard, again, he spoke about this, and I won't spend a whole lot of time on it, but you can see that the effects of the global trade war, if you will, are already starting to take place. And so we can see really this year we're starting to see a drop here. Who's most affected by this? Really, it's the countries that have exports as a large percentage of their GDPs. And so if you actually look at the countries listed here, these are the emerging world. As Leonard had talked about, the emerging markets were off 8% in the quarter. This is a big part of it, right? The trade war is going to have pressure on the ability of these countries, these economies to continue to grow, and it's going to be a headwind until some more clarity. The market finds more clarity in kind of the direction and the magnitude of the trade war. And to put it in perspective of who's most affected by but to put it on more of a scale of how this may affect individual countries, this graph here shows the trade impact on growth. This assumes that if manufacturing exports were to stop, what the impact to GDP would be, annualized GDP would be. You can see the U.S. fares right now, according to this analysis, would fare the best of these countries here should all manufacturing exports stop. And what we find is that here's the global economy, and the global economy should, let's just say the global trade engine slow down or stop. The estimate is anywhere from 10 basis points or 0.1% to 0.2% of GDP. Shave that off of GDP, which is meaningful. It's not trivial. That's a meaningful number, but it's also not catastrophic as well. And I think that's what this shows us. And so I think that's why, again, as we look at the markets and the markets marching higher, even when you take the fact of the dollar out of the equation, what happened in the second quarter, and Leonard had shown that some of the international markets are still positive in the face of the global trade war. I think this is part of it. I don't think that the markets really don't think that a trade war or the current rhetoric that we're hearing would be absolutely catastrophic to the markets, but it will have an impact to the markets. But again, this is a very fluid situation, and as we've seen, the president can be very unpredictable in the direction he takes, and so this could change at any moment in time. And then lastly, talking about emerging markets, as I said, we're still very constructive on emerging markets long term. We think that there's a lot of reasons to like emerging markets. We've talked about the valuation levels of emerging markets. I didn't talk about on slides on this presentation, but emerging markets remain to be some of the cheapest markets in the world. But really the story is long term and long term growth. So this slide is showing us what the anticipation is for the next 20 years of global growth across the world. And we can see that The forecast is about 2.1%. Last 20 years, it was 2.7%. But the interesting thing is, where does that growth all going to come from in this analysis? It's all the emerging markets. And these diamonds here show us where they were the last 20 years and where they think they'll be going forward. And what you'll see is that China is expected to slow meaningfully. Right? So China has experienced tremendous growth the last 20 years, as I think we all know. However, just because they're slowing down does not mean that they're going to not be a big contributor going forward. They are, right? They're still going to be very, 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 very important to the global economy, just less so. You're seeing the rest of the emerging markets really start to catch up. I think it's interesting to see Mexico here actually expected to grow faster than it did over the last 20 years. India, another one, has been a big part of it and still going to be a big part of it going forward. Big reason for that, growing middle class. And this is the story in emerging markets, for the most part, is the emergence of a middle class and a middle class consumer. I think India is a perfect example of this. If you look at 1994, 1% of the Indian population, this is 1 billion people we're talking about, 1% of the Indian population was in the middle class. Today, 12%. By 2030, 79%. That's 79% of 1 billion people now are going to want iPhones, TVs, cameras, cars, financial products, investments, cast iron stoves, you name it, right? And so this is the story. China, India is huge. China, Brazil, Mexico, right? All of these countries here are expected to increase the middle class. This is the growth story. And so going forward, you will probably hear us continue to say we like emerging markets, even in the face of a down 8% quarter or a down 10% year or a down 15% year. Why? Because this is real, and this will continue. We believe this will continue to happen, and we don't want to miss it. And so as this story evolves, we anticipate to make sure the portfolios have the right exposure to that factor. And so with that, I'll turn it back over to Catherine, who I believe will do a survey, and we'll open up to questions.
Okay, thank you, Todd. Thank you, everyone, for joining us today. We really appreciate you being here, and we hope to see you on the next call. Thank you.